Hi there, everybody. After the election, we now have a clearer picture of the investment environment. Therefore, I wanted to briefly discuss déjà vu. The Reagan administration was in power when I began my career, truly in the early 1980s, and there was a lot of debate around everything, much of which is still being discussed today. The same kinds of controversy. I wanted to briefly go over the macros, which include what the Trump administration claims to desire, and what might actually occur given that background. I also wanted to discuss how this clarity would affect the innovation industry, namely the field of disruptive innovation. And we think that the world is changing in, amazing ways. Thus, we would like to walk you through some of that and how these changes will likely be accelerated by this government and its policies. So, let's start by talking about macros. The early years of the Reagan administration were a highly challenging time to invest because of back-to-back recessions and interest rates that reached 15%. As you may recall, President Trump will take office after the Reagan administration completed that portion. The 80s and 90s were the heyday of active equities investing, and I believe we're entering that era again. In terms of the controversy, to start, a deficit of 5.5% at the time, following consecutive recessions. Investors in the bond market were both furious about that, but they failed to realize that the Reagan policies of tax cuts and lower interest rates, which were brought about by Volcker's decision to reduce interest rates from double digits to much lower levels, were going to have a significant positive impact on economic growth and help us move out of the deficit. The Reagan administration began to reduce the deficit in the 1980s, and the Clinton administration completed the process in the 1990s, bringing us into a surplus. Apparently, we anticipate experiencing something similar this time. We think the tax cuts are really essential, especially if Trump comes through on his tariff commitment. Even though I'm not a huge fan of tariffs, if we apply them to nations that aren't providing equal opportunities for American goods and services, rather than our free trade partners, and we respond to them domestically, by lowering taxes for businesses and consumers, then that's a good trade-off. Therefore, I don't believe that the criticism of tariffs will be implemented on a 100% universal basis. That isn't the topic of our conversation. According to my understanding, President Trump is a strong supporter of growth and will not take any action that will obstruct it. He believes that by lowering the dollar, we will become more competitive. The dollar will really appreciate because, in my opinion, returns on money invested in the United States will rise in comparison to those in other countries. This will draw in more capital. Now, the dollar's rise in interest rates is anti-inflationary, as is the productivity growth linked to a surge in activity brought on by reduced tax rates and other investment incentives. Therefore, if inflation turns out to be lower than anticipated, it will be great for strategies that rely on innovation. Actually, what has happened over the past 4 years is a surge in inflation brought on by a number of factors, including COVID, supply chain problems, and, the explosion of money growth. Despite the Fed's efforts to regulate all of that, I believe many investors have struggled to trust that it will remain controlled. Productivity growth is the key to keeping inflation under control, and AI and other new technology, as well as the dollar strengthening, are already contributing to robust productivity growth. As I mentioned before, the majority of commodity prices are expressed in US dollars. Therefore, an increase in the value of the dollar indicates that commodity prices are under pressure to decline. That's also a very positive thing. So, how would interest rates fare in this situation? Now, this isn't quite like the 1980s. At the start of the 1980s, interest rates were so high, 15%, that they would definitely decline if the Reagan administration did anything properly, and they now have. Now, 45 years later, they are prohibitive in relation to where we anticipate inflation to go and high in comparison to previous history, 5% on the Fed funds rate, Therefore, we do think that interest rates will be under pressure to decline, perhaps much more than many investors anticipate in the near future. Since I believe that a lot of activity will be slowed down by a desire to understand how policies will change in the future. As consumers and businesses, we are likely to wait if we think tax rates will decrease. This is classic. In fact, it occurred during the Reagan administration when he implemented tax cuts gradually over a 3-year period. Until the tax rates reached the level he had promised, Most people simply waited. So, in expectation of even reduced tax rates, we're likely to see some activity hold back in the upcoming year. In my opinion, interest rates will then be skewed downward. The growth in productivity is going to be enormous, I believe. This is the convergence, among the main innovation platforms that we have focused our research on. For example, robotics, energy storage, artificial intelligence, blockchain technology, and multiomic sequencing in the healthcare industry are all convergent, and we think that they will unlock explosive GDP growth, productivity growth, and much lower than anticipated inflation because they are all deflationary. They are technologically capable, and when prices decline, units soar. This is good deflation. Furthermore, because these technologies are revolutionary, it is crucial for investors, as well as individuals and enterprises, to be on the right side of change, which is why we reveal our findings. Of terms of government policies, a change of leadership at some regulatory agencies, such as the FTC and the SEC, is arguably the most significant development that will occur in the near future. The SEC has been a threat to the flow of digital assets. Because of Chairman Gensler, we have lost a lot of talent to other nations. And well, I believe that will change, we are certain of it. Please let me know if you require any other changes. How do cloud providers stack up against the other sectors you mentioned that are acquiring Nvidia CPUs or venturing into the Gen AI space? As you said in the release's remarks, CFO Colette Kress told us that those cloud providers account for 40 to 45% of data center revenue. What does the opening of these additional industries entail for Nvidia? I wonder whether the cloud providers will lose part of their market share and if these other businesses will replace them. I anticipate that they will both develop. First off, we approve of the financial arrangement, Jeff. About that, are there any sort of levers you can pull to help increase supply? Hopper demand grew throughout this quarter after we announced Blackwell. And so that kind of tells you how much demand there is out there. People want to deploy these data centers right now. They want to put our GPUs to work right now and start making money and start saving money. And so that demand is just so strong. You know, it's really important to take a step back and realize that what we build is not a GPU chip. We call it Blackwell, and we call it GPU, but we're really building AI factories. These AI factories have CPUs and GPUs and really complicated memory. The systems are really complicated. It's connected by NVLink. There's an NVLink switch. There are InfiniBand switches, InfiniBand NICs, and now we have Ethernet switches and Ethernet NICs. All of this is connected together with this incredibly complicated spine called NVLink. And the amount of software that it takes to build and run all this is incredible. And so these AI factories are essentially what we build. We build it as a holistic unit, as a holistic architecture and platform. But then we disaggregate it so that our partners can take it and put it into data centers of any kind. And every single cloud has slightly different architectures and different stacks. And our stacks and our architecture can now be deeply integrated into theirs. But everybody's a little different. So we build it as an AI factory. We then disaggregate it so that everybody can have AI factories. This is just an incredible thing. And we do this at very high volume. It's just very, very hard to do. And so every component, every part of our data center, is the most complex computer the world's ever made. And so it's sensible that almost everything is constrained. I would like to know how cloud providers compare to the other industries you claimed are entering the Gen AI space or purchasing Nvidia processors. You noted in the release's comments that we heard from CFO Colette Kress that 40% to 45% of data center revenue comes from those cloud providers. What does that mean for Nvidia as we see these other industries open up? Will the cloud providers, I suppose, lose some of their market share, and will these other industries take over where those cloud providers were? Please let me know.